I bought my first stock when I was 11 years old. It was a thrilling experience, though admittedly, I was clueless. I had dabbled with investing as early as 7 or 8, but I didn't take it seriously until I was 11. And even then, my early years of investing were filled with wild experiments and well, zero profits, but hey, it was a lot of fun. Between the ages of 11 and 19, I tried everything from charting stock prices to attempting to time the market. I was flipping charts upside down, hoping some magical pattern would jump out at me. Spoiler alert, it didn't. I also memorized ticker symbols from the New York Stock Exchange like a pro. X was US Steel and T was a TAN DT. I could recite them all. Impressive? Maybe. Useful? Not really, because despite knowing the symbols, I had no clue what these companies actually did. Looking back, I was like a kid playing with a toy cash register, fascinated by the numbers, but completely unaware of the real business behind them. In 1949, I stumbled upon a life-changing book, The Intelligent Investor by Benjamin Graham. I'd never heard of him before, but this book gave me a much-needed wake-up call. There were 2 chapters in that book that completely reshaped my investment philosophy. They were so simple, yet they became the foundation of everything I've done since. Let me share them with you. Lesson number 1. A stock is part of a business. This may sound obvious, but back then, it was revolutionary for me. A stock isn't just a number on a screen or a piece of paper. It represents a share of a real business. The key question is, what kind of business are you buying into? Instead of obsessing over stock prices, I started looking at companies' economic characteristics, competitors, and management teams. I stopped treating stocks like lottery tickets and started evaluating them as real businesses. Imagine you own a gas station with a partner. Every day your partner offers to buy your half of the business or sell you his half, and the price changes daily based on his mood. Sounds crazy, right? Yet that's exactly how the stock market operates. I learned that the market isn't there to instruct you, it's there to serve you when it suits your needs. Lesson number 2. Meet Mr. Market, the Manic partner. One of Graham's most famous ideas is the concept of Mr. Market. Imagine having a business partner who's an alcoholic, manic-depressive lunatic. Every day he shows up at your door with a new offer to buy your shares or sell you more at wildly fluctuating prices. Some days he's euphoric and offers sky-high prices. Other days he's in despair and practically gives shares away. Your job? Ignore his mood swings. Only take action when it benefits you. This simple analogy transformed the way I viewed the market. I realized that most people react emotionally to stock prices. They're happy when prices go up and sad when they go down. But in reality, the market's mood swings are opportunities to buy low and sell high. Lesson number 3. The margin of safety. Graham also introduced the idea of a margin of safety. Think of it like crossing a bridge with a 10,000-pound capacity and a 9,800-pound truck. Sure, you might make it across, but why take that risk? You'd be better off finding a stronger bridge or reducing your load. In investing, this means leaving room for error. Don't invest in something that's barely worth the price you're paying. Wait for opportunities that clearly scream value, where even if you're wrong, you'll still come out okay. Applying these lessons in real life. With these 3 principles, understanding the business, ignoring market noise, and maintaining a margin of safety, I built my investment philosophy. But there's one more trick I use when evaluating a business. I look at companies without knowing their stock prices. Why? Because prices can mess with your judgment. If you see a low price, you might think it's a bargain. If you see a high price, you might think it's overvalued. Instead, I start by analyzing the company's fundamentals. What do they sell? Who are their competitors? How's their management team? Only after I've formed an opinion do I check the stock price. Why picking stocks is like handicapping horses. Back when I was a kid, I used to handicap horse races. I'd get the racing form and calculate the odds of each horse winning. The trick was to figure out which horse had better chances than the posted odds suggested. Investing is similar. You're not trying to guess what the market will do tomorrow. You're trying to find businesses that are worth more than their current price. And guess what? You don't need to make a move every day. In fact, the best investors only make a handful of great decisions in their lifetime. One of the most important things I look for in a business is a moat, a competitive advantage that protects it from rivals. Think of Coca-Cola. Nearly everyone in the world knows what Coca-Cola is, and they associate it with happiness. That kind of brand recognition is a powerful moat. Even if RC Cola spends $1 billion on advertising, they'll never match the brand loyalty Coke enjoys. Another type of moat is location. If you own a restaurant in a prime spot, that's a moat. Or it could be a patent, like a pharmaceutical company's exclusive right to produce a drug. Here's a fun exercise. Imagine someone gives you $1 million and asks you to buy 3 businesses in your town. You can't sell them once you buy them, so you have to choose wisely. What would you look for? A business with enduring demand, a business with a moat, a business with capable and honest management, a business at a sensible price. That's how you should approach stock investing. Treat stocks like businesses you plan to own for life. Most people think investing is about chasing the hottest stocks or making quick trades. It's not. The real secret is patience and discipline. You don't need to swing at every pitch. You don't need to make 100 investments to get rich. If you make just 5 great investments in your lifetime, you can build immense wealth. Think of it this way. If you had a punch card with only 20 punches for your entire life, you'd think long and hard before making each investment. That's the kind of discipline you need. Investing isn't about following trends or reacting to the market's every move. It's about understanding the businesses you're investing in, waiting patiently for the right opportunities, and taking action when the odds are in your favor. And remember, Mr. Market is there to serve you, not instruct you. So next time he shows up drunk and babbling nonsense, just smile and wait for the right moment to strike. After all, investing is a game of patience, and it's a game that rewards those who wait.